Welcome in our next guest, that is Gary Shields, chairman at the Nassau Street Partners. Gary, very nice to see you. We were complimenting you on your background just in the commercial break there. Very, very nice. But look, we're not here to talk about that. I'm here to talk about, obviously, the markets. Just talk us through your thinking here, because obviously we've seen a nice recovery for some of the more beaten down areas of the market, like your softwares, like your financials, like your Bitcoins in recent sessions. I suppose the big question is whether this can hold.
Well, I think that and by the way, I wanted to bring a little sunshine to New York to you. This is where I took that photo about 2 hours ago. So thank you for having me on. I think the market has an opportunity. It's sort of a normalization year. And I think if we can keep inflation under control, and, the Fed is looking at incremental changes in interest rates, I think the market has the opportunity to continue to move higher.
And Gary, you had to just rub it in for us here, freezing, that you took that photo. It's not a stock photo. You took that photo, so you are in that beautiful location.
This morning.
In that beautiful location.
My vineyard has some weeds growing in it. It's time for the tractors to show up, but they're starting to bud. So.
Well, let's go with a vineyard analogy then. Where in the markets right now are you seeing the weeds, and where do you expect to see the tractors coming, to deal with the cracks?
Well, I think that, I think the conversation couldn't happen if we didn't talk about AI. I think AI will continue to drive a lot of the market, and that will drive opportunity in software and in the technology space. I think defense, has an opportunity, but I'm really sort of thinking, trying to comment on the overall market environment. And I believe that there are no signals that I see that would harm the fundamentals or the systemic direction of the market. The elements that have been in play during prior crashes just aren't here. I mean, we've got plenty of liquidity. We've got credit markets signaling calm. We have balance sheets stronger. We have earnings that are strong. Liquidity strong, and so I think overall the market has an opportunity to continue to move up. So.
Okay, but does it move in sync? Because obviously we've seen a lot of the concern coming from the AI trade around some of the disruption fears, and that's where we've seen a lot of the market participants sort of hedging some of those worries in places like obviously the more sort of cyclical parts of the market, obviously in bonds, international markets as well. Metals, talk to us about what you're seeing there. I mean, what is likely to benefit this year, do you think, if tech isn't playing the role that it has in recent years?
Well, I'm not an expert in metals, so I don't really, I don't really follow gold and silver and those kinds of things. But I actually think that what we're seeing, for example, is that there will be a move toward investors looking at the picks and shovels that control AI. And the liquidity-driven market is probably over, and we'll see the markets driven by, as I say, the companies that have stronger earnings, stronger revenues, good cash flow, and strong balance sheets. So, that's where I would suggest that investors focus. I'm not so much a, hey, you should be in this sector or that sector, because those can change over a period of days or months or even a year or so. But my concern is that you avoid some of the really big moves and the market crashes, and I just don't see anything leading to that. As I said before, I believe if the Fed can deliver incremental changes in the right direction, meaning down, that we'll see strength in the marketplace overall.
All right, Gary, so then instead of focusing on specific sectors, let's talk about the thing that seems to be affecting every sector right now, and that's, of course, AI and these disruption fears. You said in the notes that you sent over that you make a very clear distinction that from your viewpoint, AI is structural. It is not cyclical. What evidence tells you that this CapEx cycle has real staying power?
Well, I've been through a lot of cycles, and it's sort of interesting. I go back clear to the 1987 crash and watching the cycles and watching the dot-com bubble and biotech bubble and all of these bubbles, and you develop an ability to see things that have staying power, and I think AI just has the staying power that can drive a lot of different sectors, I don't know if that actually, if that addresses the question, specifically, but I think overall we've seen sort of the rush toward AI, invest in everything AI. That was last year's news. I think now what we're going to see are companies in the area of robotics and storage and other. I covered storage on Wall Street years ago, and but some of these other sectors, power and others that drive AI, and then beyond that, we'll see these specific software companies that are developing solutions that again can be strong players. So I just see a long-term play in that and a sustainability. The companies in AI are making money. The companies in a lot of cycles in the past have not made money. I point to 2000, the dot-com bubble is a perfect example of story stocks and that kind of thing. I don't think we're seeing that in AI. So I think that's sustainable.
What makes you so convinced that we're not seeing it in AI? And I just wonder, because obviously with the story regarding financials, it's not been a case of, okay, AI is coming to eat the lunch of the wealth managers and maybe some of their business models, but more about the AI funding. There's been a lot of conversations around the debt to equity ratios, particularly with names around Oracle. You've got Alphabet, you've got big companies sort of tapping the debt markets now in other currencies as well. Just talk us through that, because you've had Jamie Dimon, talking about cockroaches, and more recently people doing dumb things and sort of drawing parallels to pre-GFC as well, which you lived through professionally. So just give us a sense of what makes you so convinced on that.
Well, a lot of companies tapped into the debt markets, the credit markets a couple of years ago. When we had easy money and free money and that type of thing, and they've been able to strengthen their balance sheets. And I'm not sure that I don't see the over leverage that has existed in prior markets. So that doesn't worry me so much. The credit spreads are at close to historic lows. We don't see high yield markets flashing distress signals. So it doesn't bother. It doesn't concern me as much. Although at some point, I think, taking on a lot of additional debt could impact some particular stocks. I don't see that being a major macro issue.
All right, a bullish view there with a beautiful view behind you. You brought us a great piece of analysis: sunshine, wine, solar panels, I think they are in the background as well. Gary, really appreciate it. Please come back and do it again. Gary Shields there from Nassau Street Partners there.